Hello friends, my name is Vikas Agrawal and I am the founder of AIF and PMS Experts India. We are one of the largest platform for alternate investment funds and portfolio management services in India. So we basically we are a boutique wealth management firm and cater the need of HNIs and ultra HNIs investors. And our endeavor is always to help these investors, educate them, empower them so that they can participate in Indian capital markets through these non-conventional instruments, I would say AIFs and PMSs. Now I'm glad to share that AIF and PMS put together as an industry is growing very fast, and we're also witnessing huge amount of value migration from mutual fund industry to portfolio management services and alternate investment funds. Particularly we saw good amount of response coming from HNIs and ultra HNIs and some of the family offices taking a lot of interest to understand these unique offerings which has its own advantages and sort of benefits in terms of enhancing the overall experience as well as returns. So at AIF and PMS Experts India we keep organizing these knowledge based sessions. We call it Ask the Expert Show, and the idea of Ask the Expert Show is to invite industry experts, read their mind, understand what's happening around. And if you want to see more of these shows, you can visit aifpms.com. There you will get the series of these events. So I'm glad to share that we've concluded more than 100 shows in last 2 years, and we're getting very good response from investors. We've got more than 5,000 investors on our YouTube. We've got more than 10,000 subscribers in our website. So thank you so much for your continuous support, and we promise you that we'll keep bringing these shows more often and keep educating and empowering you with more knowledge. So with me I have Mr. Mayur Shah in our studio. So Mayur Shah brings about almost 17 years of rich experience when it comes to investing in equity markets particularly. He's the portfolio manager at Anand. So he began his career with Kotak Investment Advisors and went on to become fund manager, and he's been managing funds for almost 5.5 years now. So today we thought we'll invite him and read his mind and understand what's happening around the world. So thank you, Mayur, for accepting our request and coming all the way from Bombay to Pune and agreed to do this show with us.
Yeah, thanks a lot, Vikas and team and entire team of AIF and PMS for inviting me for the show. Yeah,
thank you. So Mayur, what we're gonna do is the agenda of the show is very simple. What we're gonna do is to talk about 2 or 3 things. One, we're sort of hearing a lot of noise from around the world that the US markets are going into recession, and then entire Europe market is suffering and they've got major energy crisis, all that. On the other hand, we saw IMF giving their estimates. We saw India continues to be the fastest growing economy in the world. But then it cannot be looked at on isolation basis, obviously, because we have a correlation with these developed economies as well. So as a portfolio manager, what's your take on this? Where do you think we are headed as an economy?
Right. Definitely there are some worry signs in the market at this point of time. People are cautious, investor community are cautious, even the foreign investor for that matter, they are also going cautious on the market at this point of time. One thing that initially that you told that people are fearing about recession. If you look at all the data points right now, recession is where prices starts going down. We are still getting all the data points which are on the inflationary side. All the numbers which are coming out right now from the US market, Europe market, they are facing the heat of inflation. From a journey from an inflation to a recession, it's a long process, definitely. Right now, all the measures what central bankers are taking, they are just trying to see to it that how the inflation could come under control, because they are seeing a decent amount of demand coming. No doubt the inflationary pressures in the market, that the global market was more of a supply side issue because of the supply of energy, the energy crisis that you rightly pointed out, which is affecting the European market. So no doubt energy and food, these are the 2 segments where the inflationary challenges are coming in this particular market. Apart from that, apart from energy and food, rest all other core items have already started to come down. The very recent Fed committee meeting which was announced, They have also told that yes, certain amount of challenges with respect to inflations have started to come down, but yes, energy and food, these are the two main areas that we need a concern, where we are concerned for the same.
Sure.
So right now, as a first step, what we believe, maybe just because of a base effect, maybe 2 months down the line, you will see a different picture. The entire inflation prices, the prices which has started to rise into the market, be it oil prices, metal prices, the supply logistic issue which was there, the freight charges, the globally which was moving on a higher side, those were the cause of concern. Freight charges have corrected, metal prices have corrected. In food items, some food have definitely corrected and they are trading low. Some items are still on a higher side. But if you look at the prices of oil and food which were 1 year back and the prices after 2 months down the line, if we are remaining at the same level as of today also, automatically the base effect will start pushing the inflation on a lower side. And that is the reason people know that yes, within next 2 months, 3 months down the line, whatever the numbers of the inflation that you are seeing, that will automatically start coming down. But yes, are we happy with that kind of an inflation? The answer from a developed market would be no, because whatever rise that has happened, it has created a damage. And because of that rise in the prices, although in base effect might reduce the inflation percentage, but the prices has increased. So that is a cause of concern. And interest rates which are moving on a higher side, that is definitely creating I can say discomfort for equity market right now, because there is always, I can say, a risk arbitrage between asset classes. So when debt markets are giving you a better return, certain amount of money definitely flows out from equity market.
Sure.
So last 8 to 9 months, what we have seen, whatever selling that has been happening from an FI perspective, there were two reasons to it. One, yes, interest rates rising globally, so that was the money was shifting from equity to debt. And also from an emerging market perspective, China is not doing pretty well. So any investor who has put money into an emerging market, definitely in emerging market, China has a bigger percentage allocation, that is more than 30%.
Right.
So if they want to move out from emerging market, pressure is there on China also, but even some pressure is there on Indian market also. So we have seen the flow of money moving out from Indian markets too at this point of time. Looking at Indian macro right now, world market, we know the challenge, what is happening in the world.
Right.
We come back to the India.
Yeah, so I want to talk about what is the domestic story.
Right. So if you look at the Indian market right now, 80% of the Indian GDP, I can say we are self-sufficient. 20% is our total export. Out of that total export, around 13% is a financial services, or I can say travel services related or IT service related, all those kind of exports that we are doing. 7% are merchandise exports that we are doing over here. So leaving apart that 20% segment, rest all 80% of the economy is self-sufficient. They are able to internally meet the demand and supply also. Post-COVID, what we are seeing, a tremendous amount of demand has started built up in the market. There was definitely pent-up demand also there, but lot of capex side of the activity has started by the private players, which was earlier missing. Because why I'm saying so, because if you technically look at the Indian market, we made a peak in GDP way back in 2018. 2018, March 2018, you check the GDP figure, which was inching more than 9%, and now subsequently from 2018 till date, our GDP growth rate was slowing down constantly.
Right.
During COVID crisis, we went into a negative trajectory. What government had did in the initial first 5-6 years, that is the Modi government from 2014-15, it created definitely lot of hope, because the government is more towards focusing more towards the growth of the economy, the vision also that they are carrying. But first 4-5 years went up in a cleanup exercise, I can say, making system more and more compliant, coming out with demonetization, coming out with GST, RERA. So all those measures initially dented to a certain extent the business sentiment, and post that, now what we are seeing, the gap which was created in terms of private consumption, the gross capital formation, that is the numbers that we look at. Now that gross capital formation has started into the market in India. You can see all the order books outstanding of many of the cap goods, engineering oriented companies. That is just giving us a vision that next 2 to 3 years are really good for the market. But yes, one is the fundamental side of the story, that market for the next 2-3 years are really good. They are going to grow. As an investor, along with the fundamental, you also need to look at valuation. So this is the thing that is right now, I can say, halting in the market at this point of time.
Sure.
Because we are not cheap. We did correct with the global market, but we again bounced back very sharply in last 1 year.
Yeah.
Because lot of support was there from a domestic investor. So we are getting more and more towards matured kind of an economy at this point of time. So domestic investors have lot of confidence and trust right now, because they are not facing that kind of a challenge which the global market is facing. The industry in India, the business setups are in India, they are not facing those kind of challenge. Even if you look at the IT numbers, the companies which have recently declared, the technology companies, be it TCS,
Yes,
Infosys,
all their results
although
are-
we were thinking that there might be some subdued remarks that might be coming out from the management of these companies, but no one is still date talking about clear-cut recession. In fact, some of the IT companies has increased their revenue guidance also.
Right.
So things in India are relatively different. What we are worried about is the valuation. We have not corrected, and the world market has corrected. So based on relative basis, yes, we have expensive compared to the developed market over here, but our growth rates are still going to be much better. If any investor across the globe, if they start thinking that yes, the interest rate cycle has peaked out, and if they now again come back into equity market, then India is definitely one of the most favored destination where the growth rate is also really good at this point of time.
Right.
So I don't see any reason why one should not be coming into India, participating in the Indian equity market. It is just the time, I can say, maybe 3-4 months down the line, things would be completely different for Indian market now.
Right. So since you represent, Anand Rathi, the asset management piece, can you talk to us about how do you manage funds, and what are the things, 2-3 things that you look at before selecting these businesses?
Right. So I have been managing the funds for the last 5.5 years as a portfolio manager. There are 3 different strategies that I have conceptualized, design also, and I'm running the same also over the last 5.5 years right now. We are more on the active side of the fund management. What we do, we are not like a passive side, that we are just buying a stock and sitting idle for 3 years, 5 years. Although when we buy a stock, there are definitely certain amount of stocks which we hold for very long term also, depending upon if I am comfortable with the valuation of that stock, depending upon whether the earnings outlook is remaining intact for that particular stock. So we don't keep any target or stop loss for any of the stocks that we have bought. But yes, we constantly keep a check on certain parameters. That is a review strategy, that is what we call it as. That is a regular view that we are keeping on these particular stocks. V stands for valuation, keeping a check on valuation at constant interval. Many a times it does happen that back to back, if the company has delivered 2 quarter very good numbers, people try to extrapolate, and suddenly the price moves up ahead of the earnings. Now there are chances that stock will go for price wise correction or a time wise correction. There is an opportunity, we shift from that stock and get into another stock. Same way, then we look at I stands for impact of any event. If any event is there which is impacting the earnings for the next coming 6 months or 1 year down the line.
Sure.
So either I need to wait for 1 year, 2 year without any material return on that particular stock, or it is giving me an opportunity, better I move out from that sector and stock for the next 1.5 year and get into another stock which is giving me better growth visibility.
Right.
So any events which are coming in, accordingly we are taking a call into our portfolio. Then it comes about earnings visibility check. Constantly keep a track on the earnings. If the earnings are meeting our expectation quarter on quarter, whatever numbers are delivered by the company, we have built in certain expectation. If the numbers are as per our expectation, continue with that company. If numbers are not coming as per our expectation, and day by day our visibility on that company or our confidence on that company is going down, after 1, 2 or 3 quarters, definitely we take a corrective steps that better we move on from that company. And last, W stands for the weightage. We constantly keep a check on the weightage that we are having in one particular stock. at any given point of time, if the weightage of a single stock in my portfolio crosses more than 10%, we do regular partial profit booking. So 2-3% from the top, again we reduce and we bring back the allocation to around 6-7 or 8%. So this is an active management strategy that we are doing for managing the regular course of investment.
Sure.
As far as the stock selection goes, just to give you a few highlights, like what is our thought process when I'm identifying a stock. Definitely the philosophy that you have laid out in while designing the portfolio, first criteria is given to that philosophy. As we have one of the philosophy of running a multinational companies portfolio, MNC PMS, whereby we are investing into companies which are listed in India but owned and promoted by foreign players. So first criteria is any which way designed by the philosophy itself. So definitely
So
most
you have
of the
MNC
stocks.
benchmark also in it?
Yes, so multinational companies index is there, which is the benchmark for the same, that is Nifty MNC index. And there are close to around 90 odd multinational companies which we are tracking actively, which are having size of more than 1000 crore market cap. So we are, first filtration is already done based on the philosophy. So in all the three strategies, whether it's MNC, whether it's Impress portfolio or Decennium opportunity, the strategies itself is giving me the first level of filter. The second level of filters are definitely understanding more and more about the company, trying to understand the business model of the company, the business competitive advantage, the business mode that company is carrying over the last 5 to 10 years, how they have been able to grow in this last 5 to 10 years. So everything revolves around trying and understanding how solid, strong business model, whether they are generic, whether they are a niche, accordingly we are trying to build upon.
Right.
Second important is the operational metrics, the working capital management. That is very critical. Then people normally just look at sales and PAT figure. People fail to realize how operationally the company has done very well. So that is nothing but how they have managed their net working capital. So that is how they have managed their working capital. With a lesser working capital, if they are able to do better turnover, so sales to asset turnover ratio, or the net working capital to sales or asset turnover ratio, those ratios we try to evaluate. And finally the ROE and ROCE. So there are many different parameters for different segments and sectors we try to evaluate. After that, yes, corporate governance and earnings visibility, the growth futuristic, both things we try to figure out, and then we go and find out the stocks which we want to be a part of.
So one good thing is that somebody is looking at investing in multinational companies, and these companies are known for their integrity, their ethics, their standard of working, their employee friendliness. So somebody is looking at that, and there are a lot of employees who are in the top management at these multinational companies. They're more familiar with this thing what I'm talking about, and if they want to invest their money in these multinationals and participate, this is the portfolio for them, because it's a unique portfolio and nobody else is running MNC portfolio as far as I know in the industry. And we basically consolidate the performance of every portfolio manager every month, so we keep a track on that. So that's a wonderful job that you're doing. And the other thing is, I also wanted you to speak to us about your Decennium Opportunities Fund, so how are you looking at that? How do you construct the portfolio there?
Right. So coming to this Decennium opportunity, the Decennium word itself means a decade full of opportunity. So we are looking at an India growth story, a person who is believing in India market right now, that next 5 to 10 years we are definitely going to be from a 5th largest economy, we are going to step one more ahead, that is 4th largest or 3rd largest next 5 years or 10 years down the line. There are definitely certain sectors which are going to pull this economy to that level. It is not that all the sectors are going to participate in a similar manner. There are some sectors which would be an average performer. There are certain segments or sectors which will be having a better growth compared to the average growth, and some sector might be little subdued. This particular portfolio Decennium opportunity that we are looking at over here, the sectors which are participating in an ongoing industrial revolution, the 4th and 5th industrial revolution that we are talking about in this particular era at this point of time, there are a lot of businesses which are going for some transformational changes. Disruptive technology is taking over. And I can say these are some of the new age sectors, the sectors which were never thought about. This could be a sector. That sectors also is now
solving the
coming
bigger
up.
problem.
Yes. So now with this industrial revolution at this point of time, there are certain sectors we believe which are going to definitely have a better growth. Some of the sectors that we know, that's like in auto, electronic vehicle is taking the leadership over here. Clean and green energy, same way, the renewable source of energy over here, wind, solar, hydrogen fuel cells, the blending of ethanol. Same way, artificial intelligence, data analytics, industrial automation. Same setup like something you are also having, like an aggregator kind of a digital aggregator kind of a business, or the e-commerce players which are there. Defense, telecommunication. There are certain sectors we know that lot of capex and the money is flowing into that particular segment and the sectors. Definitely lot of growth opportunity is available in those emerging sectors that we would like to participate. So our first part of the strategy is going towards industrial revolution. The second part of the strategy in destiny of opportunity is going towards business upcycle. So in business upcycle, there are many, I can say, if you look at any particular company also, in their life cycle, there are period of contraction, period of expansion also. Period of expansions are usually called as business upcycle.
Right.
For example, we have seen auto industry and banking industry very recently, after seeing a consolidation of 3 to 4 years, they have started moving in their business upcycle. 1.5 years back, we have already seen the real estate market also started to pull up. However, we are also looking at one different way of business upcycle over here. There are certain industry and sectors which have never went for a contraction, never went for correction. They are still growing, but they are now going to witness an accelerated growth rate. So those companies are also part of our business upcycle. These are chemical companies, API manufacturing companies, engineered product companies, electrical goods companies, wherever government is seeing that yes, India has lot of potential, lot of capability in those segments, sectors. We just need to scale up our business. If we increase our scale of this business in these particular area, government is trying to provide them with PLI scheme, export incentive scheme to scale up this business. We can become a good global supply partner and try to take the advantage of the current recent phenomena of China plus one strategy, and now people are also talking about Europe plus one kind of a strategy. So this is where certain sectors are going to be witnessing an accelerated growth. So we are having a dual focus strategy in this destiny of opportunity: industrial revolution, new age economy or disruptive technology, and the second part what we are looking at is the business upcycle.
Right. So, there's a saying that the returns are basically a function of the markets. I would say the returns are also a function of the behavior, investors' behavior. And I keep getting this question from a lot of investors, and they keep, for example, recently in the recent past, you saw Ukraine war taking place, and then, market tanking by good 25-30%. Some of the stocks went down to the large extent of even 50%, like Dr. Lal Pat, etc. Basically, my question is that these investors really sometimes get concerned about markets, and markets has its own volatility, and what's your message to our investors? How should they behave when market turns negative at times or tanks by good 25-30%? And that's one. And second is, should we really get panic because we are looking at investment for next 10 years? Where do you see India in next 10 years, and how should these investors behave?
Right. So you need to understand first, and as an investor also, you also need to evaluate yourself at what stage of wealth creation you are, because different investors would have different objective of investments. For example, an early age investor or an investor who has already crossed maybe around 35-40 years kind of an age, but he's still earning. He's constantly getting more and more money to be deployed into the markets over here. So for him, all the corrections which are coming in the market is an opportunity. He should be more thankful that yes, he has got an opportunity that markets have corrected, and he's getting that opportunity to put more money at a lower level. So it's a belief. You need to believe in the market over here, believe in the Indian economy. We are an emerging market. You are also growing wherever your business setup is there, your profession is there. So if you are growing, then definitely the economy is also growing side by side. It's a belief that you need to always carry when you are investing into equity market. Second, if you are an investor who has already reached to a particular level, that you have already accumulated wealth, Now it's time for preservation. You can't afford to lose too much of wealth in a very short period of time, because market does has that kind of a tendency that if market corrects in a very short span of time, your portfolio could get eroded by 25, 30, 40% also.
Right.
So if you are in that particular I can say period where you have already accumulated wealth, the wealth preservation is a key I can say thing that you need to look at. For those kind of investors, anytime in equity market, whenever you see 35-40% plus kind of a return has got generated within 1 year or very short period of time, try to book profits, try to book partial profits and stay away from the market for those 35-40%. Whenever market corrects, again re-enter. You just need to optimize your wealth with that particular strategy.
Right.
That is only thing that you are going to help you out. But yes, the belief in the market, belief in the economy has to be there. 10 years for Indian market are definitely going to be much better. I can say not even 10 years, it's a way ahead we are supposed to go. You can just look at the economy at this point of time. Look at the economy of China. If people who have visited China, if people who have visited Europe, US market, look at the development, infrastructure, the standard of living those economies are having. There is a long way where Indian market has to go. So no doubt, being an emerging market with a very good high growth of GDP growth rate, what is being projected, and multiple sectors that we are participating into, being a self-sufficient economy, the shocks in the economy would be relatively lesser than the surprise on the upside. So you just believe in the economy and just stay invested over here.
Right, right. So they're very important. Very well said that, if you'll have to decide that which stage you are in, and based on that you'll have to take the corrective action. If you are in the stage of retirement, or your retirement is coming closer, obviously it's a concern, and that is the time you start reducing your equity weightages. But if you are really investor looking at next 10 years and planning to invest, I mean, you have good amount of time left out with you, and you're looking at enhancing your return, and you're on the wealth creation journey, then every correction is nothing but an opportunity for you to accumulate more equities. And that is the time you should revisit, check out your non-performer portfolio managers, and add more money to deserving portfolio managers. I mean, that's how you should be rebalancing the portfolio. This is how we do it at AIF and PMS Express India. So in fact, we've built up a large team now. We've got a research team, and their full-time job is to do complete research, work closely with fund manager like you, understand the various investment philosophy, work closely, give direction to investors, hand holding them, so that they should be able to create wealth. Because what happens most of the time, investors they're not able to travel the entire journey, as in they're not able to ride through the growth journey of the markets, and during the bad times they really get concerned, get panic, and they keep hearing from their neighbors, relatives that I told you that not to invest in equity, and why did you consider equity as an asset class? And therefore they come under pressure, and then they end up selling equities. So I think you should be greedy when others are fearful, and you should be fearful when others are greedy. That's the only way to create wealth. So thank you so much, Mayur, for taking the time out from your busy schedule, joining in. Appreciate. Thank you.
Thanks a lot, Vikas, and thanks a lot the entire AIF and PMS expert team. Thanks once again.